Greetings, members one and all of the Salivation Nation. Well, today was a big day with the markets. It plunged. The Dow plunged almost 800 points. A pretty big drop, erasing pretty much all of its gains. We're going to take a look at the analysis from a slightly different source. We're going to take a look here from the CNN Business, and Wall Street's enthusiasm for the U.S.-China trade truce has completely vanished. The Dow dropped 799 points, or 3.1% on Tuesday. At one point, the index was down 818 points. The S&P declined 3.2%, while the Nasdaq tumbled 3.8%. Big tech stocks fell sharply. Apple and Alphabet lost more than 4% apiece. Amazon and Netflix plunged more than 5%. The sell-off wipes out a chunk of last week's huge rally. The Dow jumped 288 points on Monday on relief about the ceasefire between the United States and China on trade. But investors are quickly realizing that the U.S.-China trade war is not over. The tariffs already put in place remain, and new tariffs could be implemented if the two sides fail to make progress. People are still very concerned about the trade war, said Dan Suzuki, portfolio strategist at Richard Bernstein Investors. Financial markets are increasingly showing signs of a fear of a recession. The selling erased nearly $800 billion from the S&P 500's market value, according to S&P Dow Jones indices. Even though it was the Dow's fourth biggest point decline in history, the percentage loss doesn't even crack the top 25 from the past decade. All three major indexes remain positive on the year. So I think that's important to remember, and it's kind of amazing coming from CNN that they would give a little bit of good news, at least for this. Trade wars fears do persist. President Donald Trump did not help Wall Street's trade war with worries on Tuesday. Trump said that he would happily sign a fair deal with China, but also left open the possibility that the talks will fail. President Xi and I want this deal to happen, and it probably will, Trump tweeted. But if not, remember, I am a tariff man. Those words are likely to bolster confidence among investors already worried about the negative consequences of the trade war. Steel and aluminum tariffs have lifted raw material costs and caused disarray in supply chains. And uncertainty about trade policy makes it very difficult for companies to make investment decisions. This tariff situation still looms large over the market, said J.J. Kinnan, chief market strategist at TD Ameritrade. And here we can see where the Dow had plunged more than 800 points at one time. Treasury Secretary Steven Mnuchin acknowledged that the market turbulence reflects uncertainty about the U.S.-China trade truce. He says the market is now in a wait-and-see. He said at the Wall Street Journal CEO Council annual conference in Washington. The market is trying to figure out if there is going to be a real deal at the end of the 90 days or not. And right now we just don't know. The volatility index surged 26%. On Tuesday, the Fear and Greed Index, the CNN business gauge of market sentiment, fell into extreme fear. And then here's where it gets really kind of scary. A recession gauge flashes yellow. Investors have grown very worried in recent days about fluctuations in the bond market. The gap between short-term and long-term treasury rates has narrowed significantly this week. Before almost every recession, the yield curve had inverted, meaning short-term rates are higher than the long-term ones. The difference between the 10-year and the 2-year Treasury yields shrank on Tuesday to the smallest since just before the Great Recession. And the less closely watched gap between 3- and 5-year Treasury yields inverted on Monday. Inversion is usually the first sign of an economic slowdown, said Kinnan. He cautioned that further evidence is needed and signs of recession are not evident in corporate earnings. That's important to point out. But there's something else that this is not mentioning that I'll talk about, which may lead the other way. The tightening yield curve reflects fears about a growth as well as concerns the Federal Reserve is raising interest rates more quickly than the economy can handle. Fed Chief Jerome Powell gave a speech last week that investors interpreted as signaling that central banks could slow its rate hikes. However, there's a debate over whether Powell really was telegraphing a sudden change. Barry Bannister, head of the institutional equity strategy at Stifel, predicted the Fed will pause its rate hikes because it has already made monetary policy too tight. He pointed to the slowdown in the housing market caused by higher mortgage rates. And that's kind of what I wanted to get to. I'll stop there to expand on that. I've heard from several different locations around my area that they're starting to see this slowdown, and it's much more abrupt than even what's been talked about here. That these higher mortgage rates are really causing a slowdown in the market. And also keep in mind that there's also other things going on that are and essentially to a point still happening that had caused the crisis in 2007, 2008, and especially with loans out and people buying more than they can afford and the like. There's still a lot of that's going on, and and it's just under a different name. You've seen documentaries of The Big Short. A lot of that stuff really hasn't been fixed, and on some level. And that, considering how fragile the economy is, as I've always said, my thought was that no matter who is president after the 2016, because of the mistakes we made, stemming from not just the financial crisis of 2007 and 2008, but how we handled it afterwards, and a lot of the mistakes we've made ever since really the Federal Reserve became a thing in 2013 and 14. I mean, in 1913 or 1914. Really, just a lot of this stuff is just coming back, and with the dollar eroding away, each one of these crises that come in has the potential to really do some serious damage if we're not careful, because kicking the can down the road can only happen so much. So we'll see what happens. Banks are getting crushed, it talks about. The flattening yield curve and slow economic growth hurt the profitability of banks. Bank of America, Morgan Stanley, Citigroup, and Wells Fargo declined more than 4% apiece. The SPDR S&P regional banking ETF plunged 5.5%, it's the worst day since June of 2016. So there's signs here. There are cracks in the wall. We'll see what happens. What does that mean for gold and silver? Well, so far today we've got palladium now on parity with gold. Palladium soared to a record high on Tuesday, fueled by speculative interest in tight supplies of the autocatalyst metal, briefly surpassing bullion, which scaled to more than a 5-week peak as the dollar slid. Spot gold was up 0.6% to $1,237.81 an ounce after earlier hitting $1,241. The highest price since October 26, U.S. gold futures settled up 0.56% at $1,246.60 per ounce. Palladium climbed 2.3% to $1,230 per ounce, having earlier jumped to an all-time high of $1,239.50. We have a tight fundamental market, flat supplies, rising demand. On top of that, undoubtedly some speculative interest, which has helped drive prices to all-time record highs, Mitsubishi analyst Jonathan Butler said. For the moment, we don't see anything changing. The metal remains in demand for industrial uses. Speculators are covering their positions. Lease market is very tight, and palladium forwards are in a backwardation. We could see some higher prices from here in the very short term. The metal, used mainly in emissions reducing autocatalysts for vehicles, has gained about 49% since mid-August. Palladium continues to fire long signals on the indicators to make new highs and is now challenging gold as reduced auto tariffs from China boost demand expectations in an already tight market. Now, this may have been before these uncertainties come, so it's going to be interesting to see what palladium does after the new uncertainty. But so far right now, as of the recording of this video, it looks to be that palladium is right about almost just a couple bucks away from gold. It's still up $24 for the day, and earlier it was up here. You see $12.39 and gold at $12.39. Essentially, it's in parity with gold. But I think the reason why it's backed off a bit is probably because of this newest uncertainty in the tariffs. But nonetheless, it's interesting to see. However, few analysts said Palladium's rally could run out of steam. Could be a profit taking at these high levels. So it's going to be interesting to see how it plays out with gold and silver. But what happens? What if we are very close to a recession? What if it's just around the corner? What's going to happen? Well, here we have some historical gold prices over the annual prices over the last since 1792, I guess. But let's take a look at recession period and just a period before the recession. We had a big buildup and a pretty big climb in prices of gold. We're just looking at gold because it's the most stable of the precious metals. And you can see that during the height of the bubble, the housing bubble, between 2005 and 2006, there was big jumps in the gold price. I mean, up 17%, 23%, and 2007 up 31%. So it had more than doubled from this time period leading up to the housing crisis. And in 2008, when it had been pretty much declared that, hey, we're in a recession that started in December of 2007, well, it pretty much laid flat there for a while. And it wasn't until 2009 when the price started to jump up again. And even so, it was at the levels just slightly more than what we saw during the previous jumps during the bubble. So it's pretty fascinating to see. And then we saw what happened here in 2010 when it really climbed up. And then we saw that the average by the end of the year, the average close for the year, they had come in 2012 was its highest, and since then it's fallen pretty rapidly back down. But now it's kind of back up again. But it never broke below $1,000 per year. 2015 we saw it got very close by the end of the year. So there may be a delayed reaction with gold and silver, but then again, it is a different time. And we're in a different place now. It's going to be very interesting to see how it plays out. It does seem like the metals react quicker. And with this big of a jump, if we have a couple of days where the markets fall, if we have a day like this again tomorrow, it's going to be pretty worrisome with the Dow Jones. But my guess is it will probably even out. I mean, uncertainty essentially. If people are saying don't panic. And don't react to this. It's over trade. Assume the worst. If you assume the worst, the markets will kind of recover, and you'll hedge your bets. And any good news, they'll climb right back up. It's been interesting. It's been a seesaw teeter-totter with the markets as of late. But nonetheless, as is always the case, we hold on to our precious metals, gold and silver. We understand that they are hedges against times like these of uncertainty. And they are reacting as typically they should in a case like this. They climb up a bit when there's uncertainty. Palladium's a little different story, but it is kind of interesting to see it now coming close to and in some cases surpassing gold. Post your thoughts below. I'd like to extend a multitude of gratitude to y'all for watching and encourage you to please rate, comment, and subscribe.